Ratio analysis serves as a foundational tool for anyone seeking to understand the inner workings of a business. It is a quantitative method of gaining insight into a company's liquidity, operational efficiency, profitability. It does this by studying its financial statements, balance sheet income statement. Think of it not as a complex mathematical exercise, but as a diagnostic process, much like a physician uses vital signs to assess a patient's health. These ratios distill vast amounts of raw financial data into a few comprehensible and comparable metrics, allowing us to ask pointed questions and seek meaningful answers about a company's performance and financial standing. It is the first step in moving from raw data to actionable intelligence. The core principle is straightforward. We compare two or more related financial numbers to create a ratio, which then tells a story. For instance, consider a small retail business that reports a net profit of 10 lakh rupees on total sales of 1 crore rupees. By calculating the net profit ratio, the utility of ratio analysis extends across a wide spectrum of stakeholders, each with a unique interest in a company's financial well-being. These numbers are not just academic. They drive critical real-world decisions. For business owners and internal managers, ratios are the dashboard indicators that guide strategy. They use these metrics to monitor profitability trends, manage costs, evaluate the efficiency of their operations. A declining gross profit margin can signal a need to renegotiate with suppliers or adjust pricing strategies, an early warning before a small issue grows. From an external view, lenders and creditors, like banks, rely on ratio analysis to assess creditworthiness. Before lending, banks evaluate short- and long-term ability to meet debt obligations. Liquidity ratios, like the current ratio, show if liquid assets cover immediate liabilities. Solvency ratios, like debt to equity, reveal long-term financial risk and reliance on borrowing. These ratios help banks quantify risk and make informed lending decisions, protecting their capital from potential defaults. Investors use ratios to spot opportunities and value companies. An investor might use ROCE to gauge capital efficiency. Market ratios, like price to earnings, P/E, assess valuation versus earnings and peers. To systematically analyze a company, we categorize ratios into 5 main groups, each shedding light on a different facet of the firm's operations and financial health. Visual, liquidity, Atse Bao, water drop icon, visual, solvency, Atse Wow, shield icon, visual, profitability, Wow, money bag icon, visual, efficiency, Atse, gear icon, visual, market, Atse Wow, stock chart icon. The first pillar is liquidity ratios, which measure a company's ability to meet its short-term obligations, typically those due within 1 year. These are critical for assessing immediate financial solvency. A foundational formula in this category is the current ratio, current assets divided by current liabilities. This ratio tells us how many rupees of current assets a company has for every rupee of current liabilities, providing a snapshot of its ability to cover its immediate debts. The second pillar is solvency ratios, which examine a company's long-term financial stability and its capacity to meet long-term debt obligations. These ratios are of particular interest to long-term creditors and investors concerned with financial risk. A key solvency metric is the debt-to-equity ratio, total debt divided by shareholders' equity. This ratio indicates the proportion of financing that comes from debt versus equity. A high ratio suggests a greater reliance on borrowing, which can increase financial risk, especially during economic downturns when earnings may be volatile and interest payments still need to be made. Knowing the formulas for ratios is only half the battle. The real skill lies in their interpretation. Determining whether a ratio's value is good or bad is not an absolute science, but a comparative art. Context is everything. However, there are some generally accepted benchmarks that can serve as a useful starting point for analysis. For liquidity, a current ratio of around 2 to 1 is often considered safe. This suggests that the company has twice the amount of current assets as current liabilities, providing a comfortable cushion to meet its short-term obligations. Similarly, a quick ratio of about 1:1 is seen as healthy, as it shows the company can pay its current debts without having to rely on selling its inventory. When evaluating solvency and financial risk, the debt-to-equity ratio is a key indicator. A ratio of 1:1 or lower is generally viewed as conservative and low risk, indicating that the company is financed by an equal or greater amount of equity compared to debt. As this ratio climbs, it signals increasing financial leverage, which magnifies both gains and losses. For profitability, the metrics are simpler. Higher is almost always better. A rising net profit ratio over time indicates improving efficiency and pricing power. For ROCE, a value consistently above 12 to 15% is often considered a sign of a strong, well-managed business that is effectively deploying its capital to generate returns. While ratio analysis is an incredibly powerful tool, it is crucial to approach it with an awareness of its inherent limitations. Relying on ratios blindly, without understanding their context and shortcomings, can lead to flawed conclusions. The first and most significant limitation is that ratio analysis is based on historical data. The financial statements used for calculations reflect past performance, which is not always a reliable predictor of future results. A company with excellent ratios today may face new competitive threats. Tomorrow, technological disruptions. Tomorrow, economic headwinds. Tomorrow that render its past performance irrelevant. Ratios provide a rear-view mirror look at the company. They do not guarantee the road ahead is clear. A second major limitation stems from the variability in accounting methods and policies. Companies can choose between different accounting practices for things like depreciation, inventory, valuation, revenue, recognition. These choices can significantly impact the figures reported on the financial statements, and consequently, the ratios derived from them. When comparing two companies, even within the same industry, their ratios may not be perfectly comparable if they use different accounting conventions. This makes it essential for analysts to read the footnotes of financial reports to understand the policies in place and adjust their interpretations accordingly. Third, a single ratio in isolation is almost meaningless. It can be easily misleading and does not provide a complete picture of a company's financial health. For instance, a very high current ratio might seem positive at first glance, suggesting excellent liquidity. In summary, ratio analysis acts as a financial X-ray, allowing us to see beyond the surface-level numbers and examine the underlying health and structure of a business. It is the indispensable process of converting raw accounting data from the income statement and the balance sheet into standardized, comparable metrics. By doing so, we can effectively evaluate a company's performance across the 5 critical dimensions: short-term liquidity, long-term solvency, ability to generate profits, operational efficiency, valuation in the market. These insights are vital for managers, lenders, and investors alike. They form the basis for more intelligent and informed decision-making. The true value of this analysis is unlocked not by looking at a single number, but by weaving a narrative from a collection of ratios. We learn to assess whether a company can comfortably pay its immediate bills,